Hi everyone. In this video, I'll be showing you guys how to do top-down analysis the right way. Now, these questions have been asked throughout the 2025 Forex Trading Empire that if I were to make top-down analysis easy, that you can easily copy and easily do a top-down analysis on any currency you wish to trade, then this video will be answering those questions on how to do top-down analysis the right way. So first, I will make it pretty easy for you guys to understand top-down analysis with this video. I will try to explain it as easy as I can so that you can easily implement this to your own trade plan to do your top-down analysis the right way. And I will be using this system on USD CAD on a sell trade. And I'll try to explain on how you can put this together and how you can do the top analysis the right way to know when to wait and when you're looking for a specific pattern for you to trade on. Before I start, make sure to like and subscribe to the YouTube channel. So first, before we get started, let's talk about knowing your time frame. Now, know your time frame, what I'm trying to explain is for you to understand that when it comes to top-down analysis, I know that in lots of other traders' videos on YouTube, you hear about them using more than three time frames for top-down analysis. To me, they're trying to complicate it in a very high and vast way. They're trying to complicate top-down analysis. If I were to tell you that top-down analysis can be achieved with only two time frame, then it's optional for you to add up any other time frame, but it's never necessary for you to add up more than two time frame. And I've been trading for a long time. I can tell you guys that you can do top-down analysis with only two time frame. And in those two time frame, one will be using to get the narrative and one will be using for your entry. There's no sugarcoating to it. You only need two time frame for you to achieve a good trade setup or for you to have a good trade plan. Now, knowing your time frame is you deciding on a specific time you will be trading on, depending on your available time to look at the charts, depending on how you feel you can implement trading to your own lifestyle or to your own life, based on how you can trade the market and when you be fully available. Which normally you guys know we have the swing trading, we have day trading, we have intraday trading, and we have scalpers. You can scalp, you can do your bias from a higher time frame, bring it down to lower time frame to scalp on the 1 minute, 15 minutes, or even the 5 minutes. Now, how you can achieve this is knowing your time frame. In this example, I will be focusing on the daily time frame and the 1 hour time frame. Now, this is used for day trading where you are holding trade to the next day. In most cases, most of the trade would have played out that day, but it's a great way for you to start in order for you to understand top-down analysis. And at the same time, I will show you guys how you can apply trading more than three time frames, where you can use more than three time frames for you to understand top-down analysis. I'll be setting it up step by step so that you can easily understand how you can trade with a base of two time frame. Adding up any other time frame, I will explain why you are adding up any other time frame. But in this top-down analysis, I will be showing you guys how to achieve it with only two time frame, which is the daily time frame and the 1 hour time frame. Second is mark up your POI on the higher time frame. Now, your point of interest, you need to mark out your point of interest first. After understanding your time frame, then you move to the higher time frame. You mark out your point of interest. I've talked about the major points of interest. If you were to go through the 2025 mentorship program, I've talked about all the points of interest I do pay attention to. The points of interest for you to focus in are the fair value gap, order block, new week opening gap, premium and discount range. So you can go to 2025 to understand more about the points of interest. I don't want to spend more time talking about those basics of a top-down analysis. You're supposed to understand that. Then this video is to help you to put everything together to learn how to implement it the right way. So you mark out those points of interest on your higher time frame. Next is understand the narrative. Now, when you've marked out your point of interest, you marked out the relevant point of interest that can help you to understand the narrative in a way that you're looking at price, you know the liquidity that price have taken out and which liquidity is closest to the current price data and what is actually drawing price or where price is supporting from or where price have resist from. Backing out the point of interest will help you understand the narrative. So understanding the narrative is after applying the point of interest so that it can help you determine where price is currently trading to. This will help you to determine the bias and this will help you to understand if you were to wait on price or to wait for a lower time frame alignment. Second is to wait for the lower time frame alignment. Now, what I mean here is that whenever you are trading a higher time frame, it's not every time on a higher time frame that there is a clear bias to where price is trading to, or there is a clear trade on the lower time frame for you to take advantage of. There are some specific price action that you need to wait for price to come to your own point of interest before taking any trade. Or there are times where you need to wait for a shift in structure before actually taking any trade on the lower time frame. Now, during those times, you wait for your higher time frame to be fully aligned with the lower time frame because you want to see the lower time frame aligning with the higher time frame narrative. This is very important. Those are the times where you need to sit on your hands and wait for price to be fully aligned with your higher time frame. Most traders do get it wrong around this part, thinking that whenever I go to the charts, I just take a trade because there's always going to be a bias to where price is trading to. Now, in most cases, I do have a bias to where price is trading to. Either I'm sticking to a weekly bias or I'm using a daily bias or I'm using a scalping. Those are based off experience, but as a beginner, trying to understand top-down analysis, trying to understand narrative, you stick to one time frame and wait for that time frame to be fully aligned before actually looking for an entry. It's very important. And it doesn't matter on which trading style you do peak. If you do peak and using the weekly chart and the 4 hour chart, I've talked about the specific time frame for you to use depending on the trading style you choose. Is in the 2025 mentorship program. But understand that you need to wait for that alignment before actually taking any trade. That is very important. If not, you'll be giving out most of your capital before the initial trade because you'll be taking low probability setup before the initial trade. So when your lower time frame is aligned with your higher time frame, then you can look for your lower time frame entry. You can see how simple it is using two time frames. Once the daily time frame is aligned with the 1 hour time frame, you look for your lower time frame entry signals. Now, those entry signals are you setting a limit order at a fair value gap or at another block or using a market execution at a fair value gap, depending on the way you do choose on entering on whatever style you do use, maybe you focus on your market execution or you focus on limit order, depending on which style you use for your entry. But you need to see the structure aligning with the higher time frame before actually looking for an entry signal. So when the lower time frame is aligned with the higher time frame, you look for your entry signal. As simple as that, you're using two time frames for your bias and for your entry. Now I'm going to go to USD CAD to show you guys an example. Now in that example, I will explain on how you can use three time frames and why it's not that important for you to use three time frames and tell you guys that you just need to understand the steps, apply the steps correctly, and to give you a greater edge to your trading plan. Let's move to the chart. So I'm on a daily time frame of USD CAD. Now we're going to follow the step which I just mentioned on the other slide. We're going to follow the step according to. So first is knowing your time frame. So I told you guys that I'll be using the daily and the 1 hour time frame for this example, which actually is a trade, just a recent trade. So I wanted to talk more about top down analysis. So I'm going to use that trade for an example. Now, second is to mark out your chart. First, the whole trade idea is this trend trading lower to run out the sell side liquidity. So I'm going to marking out the chart before Monday's price action and sorry, before Tuesday's price action and Wednesday price action. So first, let's mark out our point of interest. So when it comes to point of interest, the first thing I do mark out is buy side and sell side liquidity. I do mark out a liquidity that have already been taken out so that they can give me more narrative to where price is actually trading to. So let me mark out the sell side liquidity. So on Monday, price closed and there's a fair value gap above Monday's high. You mark out that fair value gap, which is a daily fair value gap. A daily fair value gap, price took out sell side liquidity. If price was to trade lower, here's the sell side liquidity. And during the time price did a retracement to this order block, I wouldn't be marking this order block, but I will explain as a beginner, you're supposed to mark out the other block to have more narrative to what you're doing. Because price respected the other block, failed to create new swing high to run a buy side liquidity, did an internal shift, trading through the mid range of the other block. So when I talk about mid range of another block, I'm currently referring to the body of the candle. Whenever price trades to the below the mid range of the body of the candle of the other block, it makes it an invalid order block based off my own personal plan because I look at it as a low probability order block, which means there's a low chance in price respecting that order block. So price traded through sell side liquidity, traded below the mid range, did an internal shift, making it a downtrend. And our draw on liquidity is to see price run the sell side liquidity, but the immediate draw on liquidity is the sell side liquidity, which is Friday's low, which is this is Friday's candle. So Friday's low is the immediate draw on liquidity, while our overall draw on liquidity is to see price run the sell side liquidity because an internal shift in a price range is identifying that price is moving from a premium point of interest down to a discount point of interest. And a discount point of interest in this price range from the swing low to the swing high is the sell side liquidity after a run on Friday's low. So we might anticipate lower prices for price to run the sell side liquidity. So you can see how easy I just created a narrative, which I actually didn't created any narrative. I just explained what price is currently doing. And now I understand the narrative to this currency here. And you can see how easy I just did it. Understanding swing highs and swing lows, understanding what liquidity have price taken out or what points of interest have price expected, what is the current trend, and what is the likelihood of price trading higher or trading lower, which I explained. Inside this price range, price did an internal shift, trading below the mid range of the range, trading to a discount, trading through the mid range of the other block, creating an internal shift, retracing to the daily fair value gap, lower prices for price to trade lower to run the sell side liquidity. Now that you understand the narrative, next is all about the alignment to the 1 hour time frame, which is your lower time frame. Now, the alignment to the lower time frame is very important. In this example, let's say after the close of Monday's candle and price haven't retraced to the daily fair value gap, I will be doing nothing. I need to wait for price to trade to the daily fair value gap before actually looking for lower prices on the 1 hour time frame, which on Tuesday price traded into the daily fair value gap, respected the daily fair value gap, did a 1 hour shift leading to lower prices for price to trade lower. After the 1 hour shift to a downtrend, that is the time I look for an entry. And I will explain more once I get to the 1 hour time frame. But understand that during the time price haven't traded to the daily fair value gap, I will be waiting and doing nothing. I will wait till I can see that alignment before actually looking for a 1 hour trade. So remember, you need to see that alignment in price before actually going into the lower time frame to look for an entry, which is a clear example is that after the close on Monday's candle, you wait till price retrace to the daily fair value gap, and there is a 1 hour shift before actually looking for lower prices. Now, there are other criteria. You need to be more aware on what price is doing on on the higher time frame, because there might be some times where price is showing you a clear signal that is not going to run a buy side liquidity, and you need to take advantage of the sell, like this example trading lower, which I talked about in the top down analysis, but I wouldn't go into more details into it. But understand that a basic way for you to apply top down analysis is have a higher time frame narrative and a lower time frame entry. Very simple, knowing when to wait for you to use the lower time frame for an entry. You can advance to add up more time frame, which I will be explaining on how you can do it once I get to the 1 hour chart. I will explain how you can add up more time frame and the reasons for you to add up more time frames. But it's not that important for you to add up more time frame. You can basically trade with only two time frames. I think most of the analysis, or let's say strategy that I've been talking about for a while on the YouTube channel, is all about using two time frames. But at the same time, I still explain if you want to add up more time frames, what are the reasons and what are the criteria for you to wait for. So let's move to the 1 hour time frame. On the 1 hour time frame, price open traded to the daily fair value gap the first time, did a retracement. This is not a shift in market structure. A shift in market structure is to see price trade below the swing low. Instead, price created a new swing high. After forming up the swing high, you can see the initial shift in structure. Trading running out this swing low makes it a shift in structure. Taking out the sell side liquidity as a shift in structure, retracing to a 1 hour fair value gap. This should be your entry. So during this whole process of price trading into the daily fair value gap, leading to the shift in structure, you're doing absolutely nothing. You're just waiting for price to align with the idea of trading lower. Traded lower, retracement, 1 hour fair value gap. This should be your entry. But there's still multiple entries for you to use, mostly when you are in a downtrend or an uptrend. Once the trend is confirmed, you can identify multiple entry. You can see lower prices, retracement, other block, respected the other block, traded lower, and you can still see more entries, how price retrace back to this other block, used it as an entry, leading to lower prices. Now you can take advantage of it multiple times. You just need to have that alignment. And once price is aligned with the idea of trading lower, you can take advantage of it for price to run the sell side liquidity. Now, how can you apply this idea using three time frames? When you want to use this idea and you want to use three time frame, it's very easy. When you have a bias on a daily time frame and the 1 hour is aligned with that bias, which all I'm trying to say that aligning with that idea is the moment price took out the sell side liquidity and did a retracement to the 1 hour fair value gap, then you can go a step further to go into the 5 minute time frame to look for an entry. Now you can check out the 15-minute time frame if you wish, but I will personally recommend looking at the 5 minute time frame. I think the 15-minute time frame is still a little bit more stiff. You can see more data when it comes to the difference between a 1 hour and a 15 minutes compared to a 5 minutes. So going down to the 5 minute time frame, as soon as price retrace to a 1 hour point of interest. So we're going to look at the 5 minutes during the time price retrace to this point of interest to see and to show you guys how you can use more than two time frame. On the 5 minute time frame, you can see the first retracement to the 1 hour fair value gap. Now I'll go a little bit step to zoom it more closer, but I just want to point out something. This is the great advantage of using three time frames, is that you can hold up to a high R trade when you're using three time frame. Now, in some cases, after running out the 1 hour swing low, there might be a retracement that might stop you out at a break even. But you understand that in every trader advantage, there's always a disadvantage in whatever style you're trying to use on your charts or whatever style of trading you're trying to use. So when using the 5 minutes, it gives you an advantage of small stops. It can give you lower stops because when price retraces to the 1 hour fair value gap, you can see 5 minute shift in structure, retracement to a 5 minute fair value gap. Price respected the 5 minute fair value gap, stop at this swing low, and you can just target previous day low. Actually, it's not previous day's low. It's just a swing low from the 1 hour time frame. But you can see you're holding up to around 6 hour trade running to the sell side liquidity. Now, these are the advantage of using three time frame as your overall time frame when it comes to top down analysis. It gives you this advantage of taking trades like this, trades that can run for a while and you can hold it up for around a big hour. But at the same time, there's still disadvantage to it where price might retrace back after running at least 3 or 2 hour before a retracement, and you might be stopped out at a break even. Now, I've gotten caught up in those types of price action a few times, but I will tell you guys that there's still an edge trading with this idea because when you are holding a trade to the overall target, you can cover up any losses that you had before the initial trade, before the initial entry. But if you apply it correctly, I am pretty sure there's a good win rate trading this exact way that I just explained in this video. If you can apply it and point out the steps I use, you can easily take advantage of this idea. But you can see that you need to wait for the 1 hour bias to be aligned with the 5 minutes before actually looking for this trade. First, you wait for that 1 hour shift in structure, retracement to a 1 hour point of interest, 5 minute entry, lower prices. And your target, you can target the overall daily bias target, but I will tell you guys to go for the low hanging fruit because I've seen a lot of retracement that went back to my entry or went back to my break even because I didn't take profit at the right time. I was waiting for the overall target to get hit. You can always re-enter the next day from a 1 hour point of interest. So let's say in this example, you took this first trade and price kept on trading lower. Retracement to this other block, you can see after price retraced to the other block, price already respected the other block, traded lower. There wasn't much of a 5 minute trend within the distance of price trading from the other block down to running out this swing low. A retracement to this other block led to lower prices, and you can identify the trade easily. Lower prices, retracement, respected it, led to more lower prices for price to run the sell side liquidity. So you can use the inversion fair value gap, or you can use the overall fair value gap. Stop at the high, lower prices, sell side liquidity. Because if price were to respect this order block, then the next drawn liquidity should be the daily sell side liquidity, which is Friday's low. Now you can see the process I did follow. I made sure that the 1 hour is aligned with the daily before looking for an entry on the 5 minutes. You can still add up more time frame doing the same process. You can add up any other time frame you feel like adding. You just need to wait for the higher time frame to align with the lower time frame. That was the reason I told you guys you can use only two time frame. Now you can use the 1 hour time frame without the daily time frame, but you need to use the 1 hour for buyers and use the 5 minutes for entry. Very easy. I think I'll do a video about it on how you can trade the 5 minutes with only the 1 hour time frame, trading the London section, whatever way I can put it together, but it's very easy to do it. You just need to make sure you understand the narrative of the 1 hour, then you use your 5 minutes for an entry. The same thing goes to the daily time frame. Understand the narrative and the daily time frame, then you use your 1 hour for your entry. Now, the other trade entry should be here. Stop at the swing high, leading to lower prices overall targets. Now, this was actually the trade I did take advantage of. During the London section, after a retracement to the inversion fair value gap, used it as an entry because I was paying attention to this order block. Because when price retraces to the other block, the overall order block, this is the shift in structure trading through this fair value gap. Price will use it as an inversion fair value gap, and I want my stop above a swing high, above the inversion fair value gap at a swing high. So this was the initial trade. So that's it for this video. I hope you guys understand how to do a top-down analysis from this video. You just make sure you practice, and you can get it at the first time you can get it immediately. You just need to do more practice and apply the step correctly. In time, you understand how to derive a narrative on where you are trading to and what is the drawn liquidity for you to understand more. But that is it for this video. See you guys in the next video.